The UPSC CSE arena is an ever-evolving space where staying up to date becomes as crucial as maintaining a thorough preparation. With strategic planning and holistic coverage for exam syllabus, Vision IS Delhi presents GS Foundation course. Avail analysis and integration of current affairs with GS syllabus. All India test series with an innovative assessment system, inculcating post-test analysis, discussion, All India ranking, and more. Explore the holistic learning modules intrinsically designed for the ideal aspirant.
Now, this is the topic, that is US recession and deeper concerns with US economy, federal banks rate cut. Now, of course, the question is, most important aspect obviously we should explore would be impact on India. Okay, so if there is a recession, what should India be doing? Okay, so now, first of all, what would be the scope of the topic? One is, what is recession? Two factors responsible for US recession. Okay. Third, can rate cut be a solution? So for example, the federal bank has come up with 50 basis point rate cut. Everybody is expecting 25, they did 50, and now they will further do some rate cuts. Okay, so will that be a solution? Will it really pull US out of recession? Or there is something else that has to be done? Okay, and then way forward and some current data. So this is what is the observation. Now, first of all, what we should understand is, whenever we use this word recession, what is this recession as such? What is the definition of recession? Anybody? Technical definition of recession? Negative growth rate for 2 quarters and above. Negative growth rate for 2 quarters and above. Okay. And if this recession stays for a very long period and the growth falls below 10%, it turns out to become something like depression. Okay. So what are the things which you observe when there is a recession? So one is, you will find that the output is falling. Okay. Then you will observe that there is job losses. Okay. Jobs are not getting created. Job loss means unemployment, and job creation also there will be a problem. Sometimes you will also find deflationary trend visible. Sometimes, not always. Not always. And deflationary cycles are more dangerous than inflation. But here it is not the case, not for the US economy. Here, but generally you will find a deflationary cycle or a deflationary trend whenever countries get into recession. Okay, but this is not compulsory. Okay, so the outputs are less. Outputs are less. No new jobs are being created, and there is unemployment problem. And sometimes you will also find this recession is associated with deflationary cycles. It becomes even more dangerous. Why deflationary cycle if it is associated, if it becomes even more dangerous? Difficult question. There's no motivation. Why there's no motivation? All other things remaining constant, the supplier wants to supply more material at higher prices. All other things remaining constant, the supplier wants to supply more material at higher prices. So if prices are dropping on a consistent basis, the supplier might stop producing. This was a situation in China when China was facing the problems of deflation. The producers did not have the incentive to produce, and therefore Chinese manufacturing units stopped producing. And many of the companies like Amazon, even Starbucks, were over dependent on China. This is also one of the reasons for inflation, recession problem is over dependent on China. Because you're over dependent on China, and China, there was a problem with respect to the property prices, etc. And youth unemployment in China went to almost like 21%. And there was an erosion of supply chains. And since US companies were primarily dependent on China, and their outputs also got eroded. And that was also one of the reason for the economy, US economy getting affected. That is, I can say it is over dependence on one country, that is China. So that is the reason now in newspapers, they are talking about China plus one policy. Why can't India or Vietnam be one other alternative? So moving little away from the Washington consensus. For example, when we talk about Washington consensus, you talk about free markets. I will produce in those countries where the cost of production is less. This is how the country started focusing after Washington consensus. You start producing your products, shoes, whatever it is, in those countries where the labor costs are less, in those countries where the prices are, that is the costing is less, you produce there. But now you're talking about something like friend shoring. You will try to shift your manufacturing units to those countries which has good relations with US, which has good fundamentals like democracy. Are you able to get this? Okay, so these things US also should observe right now. You should not be over dependent on this country called China for your supply chain related aspects. So rather you have to think of other countries, and India is one good opportunity for US. Okay. Now, why was US getting into recession? Any country gets into recession because of two factors. One is the domestic factors, and obviously there will also be other factors like global factors. So when we talk about the factors like the domestic factors, one is over expenditure after COVID and dwindling funds. Over expenditure. That is what happened after COVID. There was huge amount of money that has been pumped by the US economy. That is US, on one side they were focusing on quantitative easing. Okay. Around $3.5 trillion new currency was printed, which was almost like 1/5 of their total money supply in the economy. You started injecting a lot of money into the economy. Okay. And then you started giving easy subsidies or funds to public as part of several policies like the counter cyclical policies. Counter cyclical. You understood what is counter cyclical now? Okay, so this was also done. Because of all that, one direct impact that US could observe is very high inflation. By the time of June 2022, inflation in US touched almost like 9.1%, which was one among the highest in the last 41 years. Are you able to get this? And US did not have so much of experience to handle this much inflation. It is unbearable. 6 itself is high for US. 6 is something manageable for India. 6% inflation. It is manageable for India. 6 is high for US. But US touching 9.1, you should understand that it is at a very high level. And that creates a lot of trouble and problem. Now, after a certain period, what happened is, though the inflation came down to almost like 3.7%, still public was suffering. That means, why? Public was suffering because already the funds they have got 81% of the population, the funds they have got is already completed. They don't have any more funds. Funds you have given, they have already spent, and they don't have cash in their hand. This is also a problem. Okay, so already it has been spent. Okay, so that means this inflation rate of 3.7 also was becoming difficult to such an extent that the public was not having cash and there was defaults started. Defaults is basically, I'm talking about delinquencies or loan defaults, especially motor vehicle loans. Very big problem. Now, why this loan defaults is a big problem is, you should be knowing that 2008 subprime crisis was also because of collapse of the banking system or big banks like Lehman Brothers. Now, current observation is also the credit card loan defaults have increased to a great extent. Even people are not paying the motor vehicle loans right now. So that is a vulnerable situation where you have given a lot of money, but you're not able to recover. Will it push US into another situation of subprime or these subprime borrowers is one important discussion that is going on. Is that okay? Another important observation is the firms' outputs have come down. Firms are facing a lot of trouble, and this US companies are facing a lot of trouble, and this is primarily because of one, AI, and because of AI, two things. One important aspect is many have lost their jobs. When they are losing their jobs, then they don't have paying capacity, then automatically demand drops. Demand is going to drop, output is going to drop, and then GDP is going to drop, and the country will get into recession. Are you able to get this? This is one problem. Okay, so especially tech companies, especially technology companies, there were huge layoffs, and that was also because of AI. Is that okay? Another important aspect is because of several global factors, US companies were not able to expand their market. So that means their output also started going down, and because of which several consulting firms, why? Because consulting firms are those which pay the maximum salaries like BCG, McKinsey. Okay, so these kind of companies also have delayed their recruitment. They have delayed their recruitment process, or the jobs which they had to create, they did not create. This is also one more issue that is going on. So US firms not doing well, or layoffs because of AI related issues. Tech companies, especially their outputs, tech companies, maximum layoffs were there. So this is something which you should understand. So not just internal factors, but also global factors. Over expenditure and dwindling funds in the aftermath of COVID. Almost like 3.3 trillion you are pumping, quantitative easing. And along with that, US also followed federal rate cuts. Why did you follow rate cuts? Obviously to increase your growth, money supply, right? And inflation 9.1, one of the highest in June 2022. This is only for your reference PPT. Increasing debt rates. Debt rates were increasing because they did not have cash. They were not in a position to pay back. Is that clear? Understood? Then vulnerability of big firms. This is basically AI and unemployment problem, directly linked. Very dangerous situation. Technology companies, 253,000 job losses in tech companies itself. And output was also falling because the global conditions are bad. They are not producing much. When the output is falling, there is no hiring or delay, especially the top class companies, or you can call them as the consulting firms like BCG, McKinsey. They are also delaying the hiring process, so no jobs are getting created. No jobs, no purchasing power. No purchasing power, then automatically demand down, output down, recession. Okay, is that clear? Another important factor is US is completely dependent on China. Remember this, I mentioned this already. And especially companies like Amazon, Starbucks, etc., they are dependent on the Chinese market. But Chinese supply chains were completely disrupted. China had its own problems. China was having its own problems. For example, unemployment rate in China was touching 21%. Property prices related issues in China. Deflationary cycles in China. Therefore, the producers stopped producing in China. And too much of over dependence on China, these companies' supply chains were hit, and that also has created problems in their outputs. Is that okay? So that is also one more important problem. Another global problem is surge in oil and energy prices. So why this is a problem? Obviously, because the barrel prices touched from $70 to $95. Okay, so this is a huge increase with respect to the oil prices. And once oil prices start increasing, then automatically it is something like the raw material, and it was creating problems for the US economy. Surge in oil and energy. So the solution that they were giving was clean energy. Okay, the solution that they were giving for over dependence on China, friendshoring. Think of those countries who have better democratic principles and who have better access with US. One is India or Vietnam or whatever it is. And diversify, don't depend only on China. This is also one more thing that is discussed. Don't depend purely on China. If you're depending purely on China, then there is a trouble. Okay. Then US bonds or US government bonds are showing inverted yield curves. Okay, so this is an indicator. Whenever US government bonds show inverted yields, it is an indicator that US economy is heading towards recession. Okay, so a regular yield curve, this is a regular yield curve. If I have to plot a regular yield, this is called as a regular yield curve. If I'm taking maturity periods of different financial instruments, this is short term, this is long term. And this is yield, if I'm taking yield here. Okay, so this is a regular yield curve. That means my long-term instruments should give me higher yields, generally. This is a very strong indicator. As long as this yield curve, there is inversion in the government bonds yields, it is an indicator that US is still not out of recession and US is heading towards recession. It's a very strong indicator. So this is called as regular yield curve. This is called as steep curve. Steep curve means there is a sudden increase with respect to the yields of long-term bonds. And then this regular yield curve becomes flat. This is called as flat curve. This is a regular yield curve. Okay. And this flat curve now tilts like this. This is called as inverted yield. Now, US government bonds, US treasury bonds are showing bond inversion. This is what is bond inversion. This is a very strong indicator of recession. Okay, so for this very simple observation is, I hope you know that bond prices are inversely related to bond yields. Bond yields. Okay, and if people are removing money from short-term instruments and putting the money in long-term bonds, short-term, and putting the money in long-term. Suppose short-term you believe that there is trouble, and you removed money from short-term and you push the money into long-term. Then if you are pushing money into long-term, everybody is buying long-term bonds, then long-term bond prices will increase. And if long-term bond prices increase, then long-term bond yields will decrease. Now, you are not happy with the short term because you believe that there is a higher risk. I am channelizing my money from short term instruments to, let's say, long term. This will lead to fall in long term bond yield. Are you able to get this? Okay, so this indicates this. So when you see this, that the yields of the long term bonds are going down, it's an indication that there is a recession which is about to come. That means people are not confident about long-term bond yields. Long-term bond yields are coming down, or they're not confident in the short term. They're removing the money and they're putting it in the long-term instruments, and long-term bond prices are increasing and long-term bond yields are coming down. Now this can also have an impact on India. That means in the short term, interest rates are increasing. Short-term bond yields are increasing means short-term bond interest rates are increasing. Short-term bond interest rates are increasing means this can make dollars little stronger. In the short term, if the interest rates are going to increase, then dollar becomes stronger. And if dollar becomes stronger, then rupee value might depreciate, making my imports little more costly. And if my imports become costly, then it can affect my trade deficit. And this trade deficit can again affect my current account deficit. This might happen. Now you might say, oh, rupee value has depreciated means it will also increase, you will be able to increase exports. But recession situation, you cannot increase exports much. And therefore, you will have higher trade deficits. Your import bills are increasing, but your exports will not increase. And therefore, you will have higher trade deficits and higher current account deficits. So there is a very strong indication clearly visible because of this aspect. That is about inverted yield curve. Is this okay till there? Okay, so reasons: overspending and dwindling of funds, and easing policies followed, vulnerability of big firms, over-dependence on China, surge in oil and energy prices. And how do I say US is strongly heading towards recession? One strong indicator which is clearly visible is nothing but the US Treasury bonds indicating inverted yield curves. Is that okay till there? Yes? Okay. Now, important observation here, very simple observations here. Okay, so one, we have understood recession and then the factors that are affecting. Now, recently, there is a report given by Goldman Sachs. Okay, so what Goldman Sachs was saying is, the chances of US heading towards recession has reduced to almost 15%. Okay, so that means US economy is slowly recovering or US economy is doing well. And it has stated certain reasons. One is in the September unemployment data, you find that it has come down to almost like 4.1%, indicating that there is some kind of positive job related. More jobs are getting created slowly. And also there is unemployment rate dropped in the recent September data. So this clearly shows that US chances of heading towards recession is only 15%, according to whom? According to Goldman Sachs. That means they are having a viewpoint. They're saying you can't say definitely that US is going to head towards recession because of three reasons. One, September data of the labor market looks positive. There are more jobs that have got created. Three, the 50 basis point rate cut done by the Federal Bank is showing improvement in the economic growth. Is that okay? So because of these three reasons, you find that there is some aspect of positivity right now with respect to US. Is that okay? Yes. But at the same time, there are some concerns. There is this Bloomberg report, all of the private entities only. So Bloomberg report says you can't be comfortable. Why? Because already $1.6 trillion motor vehicle loan is still not paid. Now, this is a huge chunk which can create vulnerability with respect to the banking system in US. And if the banking system is going to collapse, then similar aspects like subprime crisis may be visible. So one important indicator is this. Then people's behavior also started changing in terms of non-payment of loans. One is outputs have come down, jobs are not there, and their mindset is also in such a way that they have decided not to pay. Okay, this subprime borrower. Subprime is somebody who is not prime, is not a good customer. Okay, so he's not paying regularly. Prime customer is somebody who's paying regularly. So subprime borrowers, there is huge amount of non-payment of rates, non-payment of loans, which is clearly observed in the recent past. So this is basically to counter. You can't say this. These are concerns basically. Okay, so now solutions. Is there any solution? One solution is for over dependence on China. China plus one policy. Friendshoring. Don't just go by Washington consensus. where you're trying to produce in only those countries where the cost of production is less, rather move towards a different aspect or use the benefits of PLI scheme of India, start producing in India. Obviously, they are doing it. That means they're looking at India also as one such alternative. But India's problem is doing business index situation. Okay, so but at the same time, they're looking for China plus one. So strategy, this is one important aspect which is happening. Is that clear? Now, can you tell me if there is recession in US, what could be the impact on India? How will it affect India? If there is recession in US, what could be the impact on India? Which all factors it will affect India? Import prices. Okay. Why import prices? So first of all, we get maximum remittances from US. Okay, so if US is not doing well, the first impact can be with respect to those transfers or remittances which India is getting. Is that okay? Okay, so that directly the remittances movement into India might get affected. Another important aspect here is so they're moving to China. Okay, so one more thing is US is one of the largest investors who invests in the India. So the FDI movement into India will reduce. And one more observation right now is that the FII investors slowly are removing money from India and they are slowly moving to, currently they are moving to China. First of all, investments will automatically reduce because when they are heading towards recession, they will cut down operations in other countries. So investments are obviously going to reduce. But more is the recession, their risk potential will also reduce. So these investors might think of safer instruments like bonds rather than putting the money into equity markets in India. Or they will work towards more safety. They will go to those countries where the valuation is more better. And that is what is happening right now in last 10, 15 days, that the money is slowly started moving to China because China has already implemented its monetary policy easing. I think that is one impact. This can again have an impact on my currency values. This is because flight of capital. Okay. Another important aspect is India is one of the, US is one of the trading partners, with whom we have a positive trade balance. Generally, India has positive trade balance with very few countries. And US is one such country with respect to which we export a lot, they import. Okay, so now the question is, if US is heading towards recession and US goes into recession, there will be a trouble, and that trouble is obviously that the trade. It can affect my BOP or my current account deficit. It can affect my external balance. It can affect my external balance. Is that okay? So it will affect my external balance, because US is one of the largest trading partner with whom we have positive trade. Okay. US startup venture capitalist companies are major investors in Indian markets. Okay, so that is very important. Today it is all about startups and these venture capitalists. I hope you know who are venture capitalists. These are entities which invest in risky startups. So these venture capitalist companies primarily invest a lot in Indian startups, and therefore there will be a trouble if US gets into recession. Then these startups may not take up so much of risk and push money into Indian startups. These venture capitalists will become little risk averse, and therefore more startup development will not be there. This can also create employment problems in Indian economy. So the US companies are one of the job creators for India. So it will also affect my job market in India. Today, jobs are getting created by MNCs primarily. If you take IT industry also, it is primarily multinational companies which are creating a lot of jobs rather than Indian companies, Indian IT companies. So if the global markets get affected, then that will also be a problem for India. Is that okay? Understood? Okay. Then what else? What else can be problems? Is there anything else? That is about exchange rate, obviously. That is about the rupee value, exchange rate, all that. Okay, fine. This is external sector balance and issues with respect to exchange rates. Okay. That is flight of capital is there, currency value depreciates, all that problems are anyhow there. Is that okay till there? Understood. Now, should India worry or is India very much vulnerable? Okay, so there is an impact on my stock markets, which you can see right now. Money is moving off my stock markets, and the stock markets are falling. This is one problem. Effect on remittances, very important, obviously, because US is one of the largest source of remittance to India. Effect on India's startup ecosystem, as venture capitalists from US might become risk averse in terms of pushing money. Then impact on foreign investment, FDI movement and FII movement into India. That will reduce, this will affect job market as well. So reduced export demand and India's, this is all about the trade balance which we were talking about. We have a positive trade balance with US and we were exporting a lot to US and that will also get affected. This can affect my exports or the external balance. Is that clear? Understood?
A strong hold over current affairs is your way to succeed in the UPSC Civil Services examination. Brace yourself and get detailed coverage of relevant news both nationally and internationally. With the monthly current affairs revision program starting from 26th October at 5 p.m. Enroll today and elevate your current affairs knowledge with comprehensive coverage of current affairs compiled through relevant sources such as the Hindu Indian Express, Economic Times, PIB Yojana, and others. Expert support and personalized mentoring. Comprehensive assessment through MCQs and mains-oriented questions.
Okay. Now, should India worry? Or do you think India see when US was facing recession in 2008, did Indian economy get completely affected? No, we have observed that. No, reasons we have discussed, strong banking system, current account or capital account convertibility is full, not full, or there are diversified market, huge unorganized segment which is there in India. Of course, unorganized, there is trouble also, and there is sometimes there is benefit also. Huge domestic demand which can be there. You need not completely, our growth model is not export-led growth like China. Our growth model was more internally driven. It is more of consumption-led growth model driven by domestic consumption. But of course, domestic consumption might get affected, but totally we are not dependent on exports like the other countries. So we don't have so much of problem as most of the countries have. But at the same time, India will be vulnerable with respect to recession in US. India will be vulnerable. Compared to other countries, it may be less, but the impact will definitely be there. So one is you have to diversify your economy. That is multiple sectors that contribute to its stability, reducing dependence on any single industry. So more is the diversification, less would be the risk. Sri Lanka, you can observe why Sri Lanka collapsed during COVID. They did not diversify their economy, only agri exports and tourism. Other than that, there was no diversification. Of course, the political policies also were very bad in Sri Lanka. Other than that, there is no diversification of economy. And both these segments got affected. Tourism, because of COVID, agri exports gone, and Sri Lanka went into trouble. So it's very important that India diversifies its economy. It's a diversified economy. We will not depend on one single industry. If at all US gets into recession, we should be careful with respect to this. Then with 90% of employment in the unorganized sector, India's economy is less vulnerable to global economic disruption. This provides a cushion against the direct impact of external shocks. Of course, this can be a negative also, but we have written it as a positive. That means organized jobs immediately get affected. The other ways of gig which we are able to survive, okay, using our unorganized sector. Here I'm written it from a positive perspective. Is that okay? Yes. Then domestic consumption, a large domestic population ensures significant internal consumption, minimizing dependency on exports. In India, this internal demand plays a crucial role in sustaining the economy. So our internal demand, so that is what Raghuram Rajan was also saying. So Modi ji, why do you want to go ahead with Make in India? and selling it abroad, why can't you think of make for India? Because C is the major component which is driving your economy rather than I and exports. Okay, so if you should be knowing this. So when I talk about the demand side of my GDP, GDP at market price is equal to C plus I plus G plus NX. This is what is the demand side of my GDP. Okay. Now, in 2018, government was saying we will reach $5 trillion by focusing on this growth model, which is a Chinese growth model, which is called as the investment-led growth model. This is a Chinese model. That is the Shanghai model. And this model primarily focuses on two factors, one I and two exports. It focuses on I and exports, investment and exports. So whenever China is producing, let's say China is producing 100 rupees, okay, China produces 45 rupees of capital goods, and let's say, and it produces 55 rupees of consumption goods. Okay, so investment is this proportion of capital goods to the total output. So investment is China is around, let's say, 45%. But the same thing in India would be little different. India, it would be around, let's say, 29%. But now in 2018, what we were saying, what government was saying, why can't we focus on a Chinese model where you will focus on more of capital good, more machinery. Okay, so where you produce more and that increased output, I will focus on exporting it to other countries. So China has grown because of two reasons. Chinese growth model, if you observe, China has grown from external factors. That means investors were going into China, setting up factories in China, producing goods in China. Whatever they produced, they were focusing on exports. This is what is Chinese growth model. Then how was India's growth model? India's growth model, our own savings was going into banks. Our own savings were going into banks. And this savings were converted into loans. And private player was investing. Investing means he's coming up with new machines. And these increased machines means output is increasing. This increased output also primarily we were selling it in the domestic market, but at the same time in 2018 we were saying you should focus on this factor called as exports. Our exports to GDP ratio is less in comparison to China. China's X to GDP is more and our C to GDP is more, and C is a major factor for my GDP. If X is the major factor for my GDP, then recession will have more impact on my GDP MP rather than C being a major factor. Are you able to get this? Understood? This is the concept basically. And now China had one more problem. Investment-led growth model China used to follow. Okay, and it started producing. Global markets started moving towards protectionism. Protectionism is what? De-globalization. Because of de-globalization, X started getting affected. So China was, and one more thing, Chinese labor costs were also increasing, because of which their cost of production also increased, and cheap export which China was exporting also was getting affected. Along with all that trade wars with US and other problems, because of all these problems, China started getting affected. Along with all that, COVID came in, supply chain constraints, Chinese companies stopped producing. And there was a deflationary situation in China. Deflationary situation. That's why producers are not producing. And when there is deflation, they will not produce only. Deflation means prices are consistently falling, that the producers were not producing. Producers are not producing, youth unemployment went to 21% in China. Got the point? So this was the problem which happened in China, and that is the reason today government is not speaking much about investment-led growth model. And if countries like US are getting into recession, better you focus here and simultaneously focus on exports. But primarily, you should be focusing on increasing the household incomes. But if domestic consumption has to increase, credit availability should increase. But currently, the banks are facing this problem called as liquidity crisis. If banks face liquidity crisis for a longer period, the credit that is given will also reduce. and that credit will also affect my consumption. In India, that C is not just because of incomes, that C is because of credit availability. But if deposits are not moving into the banks, and banks are raising money from the markets now, they are issuing bonds and raising, that means their cost of capital, cost of raising money is increasing. They can't give loans at lesser interest, and that will also affect my consumption. Then GDP can get affected. I hope it is clear till then, right? So this is about the concept. Now, domestic consumption, then strict financial regulations. 2008 also, we were able to successfully not get completely affected because of subprime crisis, because of strict financial regulations. Okay, so that is basically the guidelines of RBI or guidelines of SEBI. Okay, SEBI guidelines are also strict and stringent, and RBI guidelines are also strict and stringent. And even now, capital account is not fully convertible, though we are in the process of moving towards complete convertibility. We are in the process of moving towards complete. You see that norms of FDI have been liberalized to a great extent. We are in the process of moving towards complete convertibility, but still it is not done completely. So these are the reasons. I hope it is okay. Understood? Now I'll take up some doubts. Any doubts you have, you can ask with respect to these two topics. Okay, if you don't want to ask like this, you can come and ask also later. But if you have any doubts with respect to the previous topic and this topic, are there any doubts? That is basically inflation spiral. See, inflation spiral is whenever inflation is increasing, there is a higher expectation for about inflation. See, there are two things here. Okay. See, economy is basically, there is something like economy is going ahead with hard landing. Okay, one is soft landing. Okay, other one is wage has a direct impact on inflation. Okay, so that means wages increase, inflation increases. Higher inflation, they may ask for higher wages, inflation expectations. Inflation expectations also they'll ask for higher wages, and increased demand for higher wages can again lead to inflation. This is one aspect. Now what we have discussed is this this demand for higher wages can also be because of increase in demand for higher wages can also be because of increase in food prices. Higher food prices, they may ask for higher wages. Higher wages, there is higher inflation. Higher wages, higher cost of production. And if agri or food products are becoming costly, what we have understood is food products are becoming costly, then the raw material or inputs for the industries cost also will increase. All this put together, again, it will end up like the cost of production starts increasing, and this will lead to again inflation. All this will also affect my, which inflation again? Which inflation? Core inflation. Though you are not taking food, it can affect my core inflation. This is called a spillover effect. So if you remove food also, don't think that food inflation will not have impact on core inflation. Food inflation will have impact on core inflation. So what is the logic in removing food, which is one of the inflation which the consumer will perception. But some economists say, no, it's not about perception. It is about long-term stability. Taking long-term stability into consideration, you have to frame the policy rather than perception. Positive impact of recession in US. Positive impact. See, you can't say positive impact in the global economy, but yes, because some markets they are losing probably, or the investors might look at US as a failed destination. Probably they can think of investing in Indian markets. Yes, there can be, but primarily we will look, because we are interconnected, we will look at it from a negative perspective more than positive perspective. Is that okay? Not FDI, FI. Huh. No, both are different. See, when I'm here, the question is currently, when I say China plus one, it is because your supply chains were hit. Whose supply chains? Companies like Amazon, companies like Starbucks. Why? Because they were dependent on Chinese supplies primarily, and therefore they were hit. Now, why they were hit? They were struggling. This was also one of the reasons. So, better would be you should have one more alternative, and that alternative should be India. Obviously, I will say it should be India, but there can be some other competing countries also. They can depend on countries like Vietnam also, and that will make their supply chain stronger. And this impact of Chinese, that means you're over dependent on one country, that can affect your inflation. This is one aspect. But at the same time, this is about foreign investments for doing business or your supply chains, production. This is one aspect, China plus one. Is China plus one already implemented? They're trying. But that alternative would be whom is the question. Okay, so, but that is a solution, one kind of solution for US. Now, moving away from Indian market is completely different. Indian market is overvalued. This is called as overvalued. Overvalued means Indian markets have a higher price to earning ratio. This is called as valuation ratios. The price I pay to the earnings of the company. This is profits of the company. Okay, profits after tax, and the price I am paying for buying the share. It is one of the ratios which indicates whether your share or your index like Nifty is undervalued or overvalued. Overvalued means you are paying more than what is the exact price to stay in India. You're paying a premium. That means tomorrow the company has to make a lot of profits to touch your P levels. Okay, so there is no guarantee. So this is all because of that demand for Indian market, because of which the prices started increasing, but companies' profitabilities have not increased in the same manner. And the companies are overvalued. Valuation wise, they're overvalued. So what happens when you're overvalued? For example, Nykaa, when it got listed at such a high level, and suddenly after a 1 year period, the share prices went down. This is the risk of overvaluation. The risk is always there, because always if you're overvalued, people will understand that and the value will come down. Okay, the share prices will fall down. So if any other destination is there where there is fair value, fair valuation, not overvalued, then they will go there, provided they look at some positivity there. So now they are looking at some positivity in the Chinese market, that it might revive, and they are better valued. That is, their PEs are better than India. And that is the reason these FIs are removing money. FIs, where will they go? Wherever they get better profits, where they feel they are more stable, they will invest there. They are not primarily interested in doing business. They want to make money by buying and selling shares. That is what they do. Here it's not about business. It is not about production. It is more about investing, making more money. So now FIs, that is the reason they are looking for better valued places, and one better valued place last 10 days is China. Because it's not overvalued, and Chinese market, all this money they're pulling out, that looking at China as a better destination because of valuations. Is that okay? So there's nothing like a contradiction here. That China plus one, it's all about productions and supply chains. Okay, this is basically FI investors looking at stock market, Chinese stock market, better valued than Indian stock market. Okay. Understood? That's all, then we'll stop here. Thank you. Yes. Yeah, this is one contention. See, that the whole logic is, in my CPI basket, okay, so in my CPI basket, if I'll show you the CPI basket. Okay, so in my CPI basket, this is the CPI basket. In the CPI basket, weight of food is 45.9. Okay, so, and then there are other things also. See, pan tobacco 2.4, clothing, footwear 6.5, housing 10.1, fuel and light 6.8, miscellaneous 28.3. Now, why did you give more weight to food? Because the proportionate spending on the maximum proportion of income in India, people spend on food. And therefore, people perceive their inflation through food because maximum proportion of their income they are spending on food. And that is the reason you have given so much of weightage. Now the household consumption expenditure survey is saying the proportion of their spending on food has come down. This is CPI. This is CPI index. No, the question is your inflation is getting overestimated, your CPI inflation, because you are giving too much of weight to this. Now household consumption, or earlier, the proportion of their income they were spending on food was higher. Now when the proportion of their consumption style has changed, they're not spending so much as they were spending on food, then why is it that your CPI basket still holds so much of weight for food? Because it is holding so much of weight, it is overestimating the inflation. So that much weight is not required. So why don't you reduce the weight for the food products? That is the logic. Okay, so why CPI inflation, why they feel CPI is not the right indicator, those who argue against it, is because primarily almost 50% is food and you have food and beverages, 45. Okay, so food inflation directly pulls my CPI. And yes, monthly expenditure of a household. Yes, that's also monthly expenditure of household. Yes. That is also household consumption expenditure data. Okay, anything else? No. See, if there is a recession in US, how should it? So, if there is a recession in US, companies are making losses. Then there is one aspect is probably companies in India which are operating. They may not be in a position to pay back the loans. Okay, so if they are not able to pay back the loans, this is basically the problem which we faced earlier, which we used to call TBS, twin balance sheet syndrome. Whenever recession is there, the company's profits will come down. Twin balance sheet means corporate's balance sheet affecting bank's balance sheet affecting corporate balance sheets. Whenever recession is there, suppose there are many Indian companies also which would have taken bank loans, which were export driven. That means they were selling their products to European markets, US markets. So all their output is going to fall because there is recession. So their output is going to fall means their balance sheets will get eroded and probably they may not be in a position to pay back the loans which they are taken. If they are not in a position to pay back the loan, NPAs will increase for the bank. If NPAs increase, profitability of the banks is going to decrease. And if NPAs increase, then banks will lend less to the market. Because of TBS problem, more NPAs, less profitability, banks will be hesitant in giving new loans. My credit expansion will fall. And if credit expansion falls, it will also affect my GDP growth. Provisioning will also increase. Obviously, when NPAs increase, I have to provision more. Provisioning will also reduce your lending capacity. What is ideal provisioning? How much should be the ideal provisioning amount? At least 70 to 75%. Okay, some banks maintain 85% provisioning of the bad loans. So, for example, SBI, etc. But more I am provisioning means my lending capacity will obviously decrease. That is different. See, Basel norms is about capital adequacy ratio. Provisioning is different, capital adequacy ratio is different. So, Basel norms capital adequacy ratio is total capital to the risk weighted assets. Okay, so here when you talk about Basel norms, if RBI governor is increasing the risk weight, so the problem you can look at it from this aspect. If there is recession, my capital adequacy ratio is what? Total capital divided by RWA. What is RWA? Risk weighted asset. Okay, so risk weighted asset is not same as loan. Risk weighted loan is different from loan. For example, if there is a credit card loan, 100 crores a bank has given. The risk weight of a credit card loan is 100%. 100%. Credit card loan risk weight is 100. Why? Because there is no mortgage, no facility. That means my risk-weighted asset will become 100 crores for this particular loan. But for example, there's a mortgage loan, 100 crore. Mortgage loan means the bank has kept some collateral and it has given loan. The risk weight, let's say I'll put it as only 50%. Risk weight is 50. Why? Because it can sell that asset and recover some portion of the loan. That means the risk weighted asset for this loan will be 50 crore only. The total loan portfolio, let's say bank has given only these two loans. One, the credit card loan, and two, let's say a mortgage loan. This is a mortgage loan. Okay. So the total loan given by this bank is how many crore? 200 crore. Is that okay? But the total RWA for this bank is how many crore? 150 crore. Are you able to get this? Okay. So what capital adequacy ratio says? Total capital to risk weighted asset. There are different types of capital, tier 1, tier 2. It is not our deposit, it's the capital which the bank is holding. Total capital to risk weighted asset. That is the formula. If recession is there, RBI governor might increase the RW. That means that means the denominator will increase if the risk weight increases. Earlier this is 50, no? If he is making this 70. Are you able to get this? That means my denominator is going to increase. If my denominator is going to increase, that means earlier it was 100 crore, now we are giving 200. According to Basel, suppose I have to maintain 8% capital adequacy ratio. This much capital I should maintain if I am giving loans. Then, if my denominator is increasing, banks have to maintain a higher capital. So, banks have to maintain a higher capital. That is how recession might affect through Basel. Okay, so that is different, provisioning is different. No, risk. What is the meaning of risk-weighted asset? It is nothing but the tabulation of loan based on the risk. See, the loan may be same for both the banks. So, for example, suppose this is one bank would have given this 200 crore credit card loan, 100 crore mortgage loan. Another bank would have reversed it. Okay, so reversed it. That means they would have given 200 crore, 100 crore credit card, 200 crore mortgage loan. The total loan for both the banks may be same, but RWA will be different. My capital which I maintain for giving loan is based on RWA and not on the total assets. Tabulation obviously based on the tabulation of the asset or the loan based on the risk. It is not about the capital. Capital is on the numerator. This is about the loan, but not purely loan, risk-weighted loan. So, whenever risk is high in the market, RBI governor says when you are giving retail loans to customers, increase the risk weight. He will say increase the risk weight. And if you increase the risk weight, automatically banks' lending capacity is going to reduce. Credit expansion will also decrease. That is the link when you look at Basel with respect to recession. Is that okay? Understood? No? That's okay. US government, Indian banks generally, of course, more than that, they'll buy RG6. Okay, so they would have invested, but primarily they have G6. RG6 are there. Okay, so. See, average cost of funds is all about, not about marginal costs. This is all before MCLR. So you should be knowing about MCLR, marginal cost of funds lending rate. What is the meaning of marginal cost? It is the additional cost incurred by the bank to produce one additional unit. That is what is marginal cost. So any change in the repo rate will change the new rate at which the bank is going to take the loan. Suppose the repo rate has been changed from 6.5 to 6.25 and now the bank is taking some loan. The new loan which the bank is taking, it would have be 100 crore, let's say it was able to borrow this 100 crore at a lesser interest rate. But when I take the average cost of last 3 months or last 6 months, the average cost incurred by the bank, when I take the average, the impact of this additional loan which you have taken will not have much impact on the average cost incurred by the bank with respect to arranging the funds in the last 3 months. Okay, so why? Because in 1 month, 200 crores you would have arranged at a higher rate. Another month you would have arranged at a little high, little less rate, and now again the rate has reduced. So that is the reason. Though base rate, the RBI used to say, why are you not reducing base rate? But the question is in base rate calculation, how much weight you should give to the average cost of funds is also not mentioned. So which factor I will give more weight is also not mentioned. It is according to the banks. But in MCLR, it is mentioned that marginal cost you should give 92% weight. You have to give, every bank has to give 92% weight in the marginal cost. So that is the reason MCLR is more effective for monetary transmission rather than base rate. That is the logic. Okay. Then that's all then. Thank you.